I've spent the last 12 years looking at tax returns of people who earn more than most families see in a decade. And I can tell you the difference between the high earners who build real wealth and the ones who feel stuck at 250, 300, 400,000 a year is almost never income. Today, I'm going to show you all five, name them, and show you exactly how to plug each one. So let's go. So the things I'm about to show you aren't Instagram financial coach opinions. They're what I see every single week inside real returns. So here's what most people don't realize. At $100,000 of income, 1% mistake costs you $1,000. At $300,000, the same 1% mistake costs you $3,000. Okay. And because high earner stake compound through taxes, through lost compounding, through equity gone sideways, that's 1% mistake over a decade isn't 30,000. It's often 150,000 or more. The good news is that the mistakes are predictable. I see the same five over and over. I call them the five silent leaks because none of them show up as a single painful bill. They drip, and the drip is what kills you. We'll cover all five. I'll show you a worked example with a lady called Sarah, a senior project manager making 280K plus K in RSUs. And by the end, you have a diagnostic you can run on your own financial life in about 10 minutes. So the first leak starts on the day you were hired, right? You filled out a W-4. You probably checked the single or married filing jointly. Maybe you wrote a number on a line you didn't fully understand, and then you never touched it again. Okay, here's the problem. Default W-4 withholding is calibrated for the average American worker. You at 250K plus are not the average American worker. You have issues, right, that withhold at a flat 22% regardless of your actual bracket. You have bonus income. You probably have spouse income, brokerage income, maybe a side business as well. So what happens? One of two things happen, okay? Either you over withhold, meaning you gave the federal government a tax-free loan of $8, $10, $15,000 for the year, or much more dangerously, you under withhold and you show up to April 15th with a surprise 5-figure bill plus an underpayment penalty. Okay? So where's the fix, right? You treat your W-4 as a living document. Review it every year. And anytime you get a raise, a new grant, spouse's job change, right, or promotion, right, if your RSUs are vested at a material level, you almost certainly need additional withholding on line 4C because the 22% flat federal withholding on supplemental wages isn't going to cover your actual 32% or 35% original bracket. This is a 10-minute fix. It's worth thousands of dollars. Leak number 2, the lifestyle gravity leak. That's what it's called. The second leak is the one everyone talks about and nobody actually measures. Lifestyle creeps, right? Okay. But let me reframe it, because spend less is not useful advice to somebody making 300. Here's what I call lifestyle gravity. Every raise you accept pulls your fixed cost upward. A bigger apartment, second car, private school, a nicer vacation. And the thing about fixed costs is they don't come off the table. Once they're in, they're in. So every future raise you get has to first cover the new fixed cost floor before it can build any wealth. The diagnostic is simple. Take your gross income, take your fixed monthly cost, housing, vehicles, insurance, childcare, tuition, subscription, need debt payments you cannot cancel in 30 days, right? Divide. If your fixed costs right, are above 50% of your gross, you're in lifestyle gravity. If they are above 60%, you're in free fall. A job loss means 90-day financial panic. Okay. I've seen $400,000 earners in free fall. I've seen 180K earners with 35% fixed costs living with real freedom. It's not income, it's the ratio. The fix isn't deprivation, it's making the ratio visible. Pull a number once a quarter and match it to the way you watch your weight. When it creeps up, right, without a matching income jump, you have a decision to make. And the decision is better made in a spreadsheet than in January when a layoff hits. The tax inefficiency leak. Leak 3 is the one that looks most like you're doing great on the surface, right? You're saving, you're maxing your phone out, you have money in the brokerage account, you feel responsible. So here's what I see on the returns. You're saving in the wrong bucket for your situation. Think of every dollar you save as going into one of 3 buckets. Bucket 1, pre-tax traditional 401k, traditional IRA. You get a deduction today. You pay tax on everything when you pull it out. Bucket 2, after tax, taxable. Regular brokerage, already taxed going in. Dividends and gains tax as they have it. Bucket 3, tax-free, Roth, okay, Roth IRA, HSA, already taxed going in. Gross tax-free, comes out tax-free. So for a high earner, the ratio across these 3 buckets, right? The single highest leverage decision you're making right now. And if your employer offers a mega-backdoor Roth, which a lot of tech and finance companies do, and that most people don't know exists, you may be leaving tens of thousands of dollars of tax-free compounding on the table every single year. I'm going to do a full video on the mega-backdoor Roth in a few weeks. For today, the diagnostic is this. Do you know what percentage of your savings is pre-tax versus taxable versus tax-free? If the answer is I have no idea, the leak is already running. Let's go to leak number 4, equity comp blind spot leak. This leak is the one that separates tech and finance high earners from everyone else. Equity compensation. If you have RSUs, ISOs, NSOs, ESPO performance shares, you have a second tax return inside your tax return, and most people do not know it. Yeah, I see 3 patterns over and over. First, people hold RSUs after they vest because the stock is going up, not realizing that holding a vested RSU is economically identical to taking the cash and buying your company's stock on the open market. If you wouldn't do that, don't do this either. Second, okay, people exercise ISOs without modeling the AMT, and they get a surprise tax bill that they can run into 6 figures. Third, people sell ESPP shares the day they vest without tracking the disqualifying disposition rules, and they pay ordinary income rates on gains that should have been long-term capital gains. So the fix here is not DIY. It's one of the 5 things I generally tell people. Get somebody who understands equity comp to look at your situation once, all right, before you make any irreversible move. I'll drop a full ISO versus NSO framework video in a few weeks, okay? For today, if you're investing more than $50,000 a year in equity comp and you haven't had a tax professional model the decisions, the leak is running out, okay? The one that makes all the others worse. At some income threshold, DIY taxes stop making sense. The threshold isn't a dollar figure, it's a complexity figure. If you have 2 income under 150K, a simple 401k, and no equity comp, TurboTax is fine. You don't need me. But if you have a W-2 plus equity comp plus rental property plus a spouse with self-employment income plus a brokerage account plus a 529 plus HSA plus state of residence questions, you're not doing tax anymore. You're doing tax strategy now. Okay, that's what you need to focus on because you're in a different situation. And the annual cost of a good tax professional, anywhere from $1,000 to $5,000, depending on complexity, right? So I'm not saying hire me. I'm saying hire somebody who is an enrolled agent or a CPA who specializes in your situation. The leak is the decade of compounding you lose by optimizing for the wrong thing. Okay. So let me give you an example. Okay. So let's say a girl named, I'm going to talk about a girl named Sarah. Sarah's a senior product manager. Her base is okay. She vests about $90,000 a year in RSUs, right? Leak one, her W-4 is set to default. Her RSU withholding is 22% federal. Her marginal tax bracket is 35%. She's under withholding by roughly $12K a year. Here's the fix. Additional $1K, right, per paycheck on line 4C equals $24,000 a year. Problem closed. League number two, her fixed costs are $14,500 a month. Gross monthly is roughly $30,800. That's 47%, below 50%. But within her rounded error, she's okay, but needs to watch it every quarter. League number three, her savings are 100% in her traditional 401k. She's leaving the mega-backdoor Roth on the table because her employer offers it. She could be putting another $30,000 per year into tax-free compounding. Here's the fix. Redirect a portion of after-tax savings into mega-backdoor Roth. Tens of thousands of lifetime dollars recovered. League number four, she's been holding invested RSUs because the stock is up. What's the fix? Sell on vest. Diversify into a fixed fund, fixed index fund. Every month she waits is a month of concentrated single stock risk. Number five, using TurboTax. The annual fee for a qualified professional would be roughly $2,500. The leaks, all right? The leaks a professional would have caught in her situation over the last 3 years, $45,000. She's been paying $75 to save $7,500. Same income, different trajectory. Okay. The difference is not more money coming in, it's fewer leaks going out. So those are the 5 silent leaks: default withholding, lifestyle gravity, tax inefficient savings, equity con, blind spots, missing professional. Okay. So run the diagnostic on yourself this weekend. Pull your last pay stub, your last tax return, and your last brokerage statement. Plug in the 5 questions. Figure out which leaks are running in your life. If you want the 1-page diagnostic template I use with the people I work with, the link to my newsletter is in the description. I send out newsletter every week. All right, no charge, it's free. And this week's edition has the template. Okay. So if you're in a situation where the numbers are complex enough that DIY isn't serving you anymore, if you have comp, right, equity comp, multiple states, spouse's business, or you've just been feeling that nagging sense that you're leaving money on the table, the link to book a consultation with the Power Capital team is also in the description. That's how we done. Okay. So next week, I'm going to go deeper on leak 1, specifically how to legally reduce taxes on $250,000 salary using the bracket and bucket structure I mentioned. Hit subscribe and turn on the bell so you don't miss it. All right. Stay blessed. All right. We'll see you next week. And God bless you. Take care. Bye.